Hi, this is Georgiana Fong of Cirrus Research. Here are some key highlights from our latest Cirrus Signals report. This is our monthly publication, which goes over key indicators that will be critical in determining asset allocation between equities and bonds, small versus large, and growth versus value. In this issue, we looked at the impact of the speculative bounce in January and its impact on our indicators. What you see is that largely nothing has changed. We are still overweight equities at over 70% allocation to equities versus bonds. And we've gone over this quite a bit in the last issue. This is not to say that equities are off to the races given what we've seen in January. It's more a relative value of equities over fixed income and where we think it's more attractive. So the model is pointing to equity still. We've seen a lot of adjustments in expectations and also supply chain improvements, and I think that would help to support equities. The downside is that the Feds continue to raise rates, which would lower the absolute return for the market. Still positive though. And besides the asset allocation, we also look at size. We're still overweight large cap stocks at the moment. Nothing has changed there. What has changed though is the style allocation model. So previously it was leaning growth. But with the speculative bounce in January, we've actually seen this shift to a neutral zone. And that's because we've seen high beta shares run as much as 17% over the low beta counterpart. And also we've seen outperformance of technology as well. We've seen them rise over 10% in just 1 month alone. And that really moved the relative value needle, pushing this oscillator to more of a neutral zone. What's important to note is that we have a shift away from growth stocks. Unlike what we had in 2021, we are in a neutral zone right now. And that's because as the Fed continues to raise rates, it will continue to pressure a lot of the growth and speculative names. On top of that, we do think that there is a long-term potential for some of the value names given the commodity cycle. Is that we will continue to see rates rise this year, and that will pressure some of the growth names in the market. Seeing the market in January is not only a huge run in speculative stocks, but it was at the expense of defensive shares, which dominate a lot of the leading names in the market. So what you see here is the Cirrus polarization quotient, which is basically a measure of leading stocks to the market relative to the rest of the market. It's put simply, it's a crowding measure. So anytime we see the market very crowded, that leads to downside pressure on the rest of the market. And the last time we saw this was around the pandemic. But what's noteworthy here is that right now, leading stocks are selling at a huge discount of 44%. And we haven't seen this level of discount since the 1970s. So what this is telling us is that crowding is definitely not a concern in the market. And in fact, this crowding measure is one of the inputs behind our asset allocation model. So that has really helped to add to that equity overweight there. So overall, the takeaway from the signals this month is that given what we've seen in the market performance in January, we should definitely not expect the market to be off to the races. We still have a lot of overhang in the market, being that the Fed is continuing to raise rates, even though at a less aggressive stance in 2023. For any questions, please feel free to contact us. And for access to the full report, please visit our website. Thank you.